Oh yeah, let's go. Crowd goes wild. Welcome to the show. This is Common Threads. We do this every Thursday night. There it is. Now it's a party out of Brooklyn, New York. 2 guests for an hour or so. We're actually going to mix it up and have some fun tonight. Drop a comment, ask a question, let us know what you think throughout the broadcast. We feature them on air. We kick them over to our guests. We have a lot of fun, serious topics, but we don't take ourselves that seriously. We start with this tonight. Today on Wall Street, the S&P 500 fell another 1.3% to officially close the session in what's called correction territory. It's a fancy way of saying the market has fallen 10% off its recent highs. And in this case, the recent high was Very recent, February 19th. That equates to trillions of dollars, more than $5 trillion. In fact, that has been entirely wiped out of the market in the last 30 days. And believe it or not, as we speak, the S&P 500 is lower right now than it was on election day. What Trump bump? We are in the midst of a multi-week market rout. And yeah, there are lots of reasons in any given day why the market goes up or the market goes down. Maybe the market was frothy, maybe valuations too high, maybe investors simply unwound the AI trade, maybe people are, I don't know, they're just on vacation. But at the top of the list is this guy, the president, the executive, one man who is unwilling or unable, I think, at this point, to clearly communicate to the business community what his plan is. Donald Trump says one thing at 10 a.m. and the markets go down, and he quickly adjusts and he says something else a few hours later to try and make the markets go back up. A president who is willing to use tariffs to punish other countries he personally doesn't like, and in doing so, he hurts Americans in the process. Because despite the daily word salad that we hear over and over again from the White House press briefing room, a tariff, in fact, is, yes, a tax on us, on you and me, the American consumer, on anything that is made elsewhere and brought into the United States. And think about things you spend money on every day. That's almost everything that you spend money on ends up coming from other countries. It's not an exaggeration to say the weight of the American financial system is now at the mercy of one man who is intent on settling personal scores and exacting revenge against his perceived enemies. Donald Trump now says, I don't even look at the stock markets. It's a dubious claim at best, given this is the same guy who tweeted over and over and over again about how big and beautiful the stock market gains were under his presidency 1.0. But now he says, nothing to see here. I don't even check the stock market. That's convenient. To be fair, I don't really think any of this, the big scary red numbers on the big board at the New York Stock Exchange, it's not a reason to panic. After all, the S&P 500 averages 5% pullbacks every year. Pullbacks, sell-offs, drawdowns, they're all part of a healthy market, a market that breathes up and down, in and out, just like you do. But in the long term, the secret on Wall Street, the dirty little secret, is that the market really only goes up. Any wealth advisor, I'm not a wealth advisor, but any other wealth advisor would tell you to have a shopping list of names that you like for moments just like this. And when the market corrects, you get all of your favorite names trading now at a discount. And in that way, maybe all of this somehow is actually a good thing. But here's what's not a good thing. A president willing to sacrifice the bull market that he inherited and even growth of the U.S. economy itself simply to upend global order, to push away our friends, to break alliances, and to cozy up with some pretty bad dudes in the world like Vladimir Putin in the process. Donald Trump once famously said this:
"We're going to win so much, you may even get tired of winning, and you'll say, please, please, it's too much winning. We can't take it anymore. Mr. President, it's too much." And I'll say, no, it isn't. We have to keep winning. We have to win more. We're going to win more.
Well, I've checked my portfolio in the last few days, and I can't help but wonder, when does the winning start? I now want to bring in the chief global strategist at Freedom Capital Markets, my good friend Jay Woods, graciously taking time out of a very busy media schedule these days to join us here at Common Threads. Jay, welcome to the show.
Hey, it's always good to be with you. I'll never say no to you.
One of the top headlines this week, the S&P 500 hitting correction territory. Jay, does anything in the stock market right now particularly worry you?
Well, I mean, each headline seems to worry us. Line risk, like the tariff tantrum. Every time you think you're, okay, it's not too bad, then something else comes out and you sell off. We've been getting some kind of good economic data, and it doesn't matter because these tariffs are what's on everyone's mind, the uncertainty in this market. So it's a little trepidatious. Now we're corrected 10%. And, when you see these things happen, you live through them, it's never fun. But historically, we've seen things like this, maybe not with the headlines behind it, but, you have to put these things in perspective and deal with one headline at a time. And from a market's point of view, try to block out that noise.
What is it? You know the stats better than I do. We usually get 5% pullbacks a year. Is that right?
5% pullbacks on average a year, one 10% correction just over a year. We hadn't had one in quite some time, almost 2 years. So this, hopefully this is your garden variety 10% correction. It doesn't feel like it right now as we live through it. Down 17 trading days, we've dropped 10% in the S&P 500. It's been a quick one. Let's see how much more we have to go. There are a couple things that have got me optimistic that we're at a tradable bottom right now.
What makes you optimistic in this market right now as we see a lot of red on the big board, Jay?
Yeah, well, let's break it down. Consumer sentiment, the AAII is consumer sentiment is reading extremely bearish. For 3 weeks now, it's been over 55% bears. We haven't seen 3 weeks at that high level since when? 2009. What happened after 2009? Oh, that was the bottom in the market, and we went on an epic run. And then from a daily basis, we haven't seen it this low or this high on the bear side since September 2022. Well, October 2022 is when we bottomed, we began to run. So it's a contrarian indicator. When you see that, you want to say, you know what, I'll take the other side of this. People are fearful. People are panicking. And then when you look at the indexes themselves, when you look at individual stocks that are down 20% in a very quick manner. The S&P 500 down 10%. The NASDAQ 100 down almost 14%. They are oversold. The RSI indicator from a technical point of view is reading under 30. It doesn't do that very often. When it does, it's considered oversold. And that doesn't mean it's going to stop, but it means we're near a potential level, a landing spot, if you will, and possibly reversal. So there are still a few things I want to see. I want to see the VIX spike over 30. I want to see outright fear. We haven't gotten a VIX spike of that magnitude since August. And then I want to see just a little more of a washout. I want to feel panic. When I see you on the floor, it's kind of orderly. I want to see a little chaos, a little fear. And that, as a former market maker down there, that's when you really want to dig in. But we're getting close to what I think could lead to a snapback rally. Does it mean it's all clear? No, but it could be a tradable bounce.
References to the relative strength index are always welcome on the show, Jay Wood, so I'm grateful for that. What should investors most keep in mind whenever they see the stock market selling off in response to Trump's tariff policy?
Yeah, it's hard to block out that noise, but you have to. These tariffs are just... it's unpredictable where they're going to go. Canada is now like our enemy. What is going on in the world? So I just look at price action. I look at these stocks from a fundamental point of view. I look at what the financials have done. Nothing has changed with Goldman Sachs or JP Morgan, but they've given up 20% from their peak. Maybe they got a little too euphoric with the Trump election, but, the path going forward looks good. To me, some of these mega cap names, those Magnificent Seven, they are getting beaten down. And you want to basically, when you go through something like this, have a shopping list ready. Where would I buy Apple? Well, I look at it technically, it's getting to a point where it's oversold. It's, if it gets to 200, it's at 209.68. I love your live charts here. This is an area of interest where I would take a shot. I could take it a shot as a swing trader, or from a long-term basis, I would buy that. Amazon broke 200. I don't like that it just broke 200, but if it gets into the 180s, it's at 193-ish right now. Amazon, for a long-term investor, these are the opportunities you want. NVIDIA, we talk about way too often, but it had 20% corrections last year. It dropped 30%. It's down 25% from its peak, while we're filming right now. But it could rally back to its 200-day moving average. That would be another 12 points higher, about 10% from where we are. So there are tradable bounces, and NVIDIA looks like it may be on its way to going back up, but doesn't mean it's all clear. It's just going back to its new downtrend, its 200-day moving average from below. But we do have an event next week with NVIDIA, so it wouldn't shock me to see a little more of a rally over the coming days. But these are big names that we all know. Everyone trades these stocks in the day trading, swing trading community. And long-term investors have this in their 401k. So you got to know these stocks. And when they go on sale, which I believe they are, you want to get ready to buy some of these. And then if you want to play defense, then you go to some of your boring stocks that pay nice dividends. You go to Pfizer, which hasn't done anything in years, but it'll pay you a nice dividend. AT&T doesn't look too bad. Good dividend. So it depends on your time horizon, your pain threshold. But to me, when I look at it, I'm seeing a few opportunities, at least on a near-term basis. And if we get a washout